Is venture capital dead?
VC has been effectively dead.
Market conditions have proved much more difficult, especially for venture capital.
The engine that built some of the greatest companies in the entire world, Facebook, Uber, Airbnb, and billions of value for unicorns is now shockingly quiet. Like right now, you are seeing virtually no IPOs. Venture capital firms are shutting their doors, and solo founders are bootstrapping $100 million businesses without raising a single dollar from VC. Like, what happened to this asset class? It used to be cool, sleek, modern, sexy, necessary, but now, I don't know. Let's unpack the story here. For decades, venture capital used to be the holy grail for founders. Have a great idea, you raise capital, you grow, you ring the bell at the IPO, boom, you are a millionaire, multi-billionaire, right? That was the playbook in the early 2000s. Like if you look at the biggest names in the S&P 500, they all raised some form of venture capital. Like it was even mainstream enough to have its own television series. Private equity doesn't even have its own TV show. Venture capital did. And if you peek inside the offices of like what were happening at these venture capital firms, all on Sand Hill Road, which is funny enough, like one actual road that has most of the large venture capital firms, this is what was happening. Like you were seeing billion-dollar funds being raised by some of the top dogs in VC, like Sequoia and Andreessen Horowitz. And also you were seeing top talent from those firms leaving, starting their own firms, and raising hundreds of millions of dollars. Like LP allocation to the venture capital asset was massive. Like I want you to take a look at what was happening from 2010, post-recession, all the way to 2021. Over the span of 11 years, venture capital grew massively. And the number of firms and the capital raised and the deals done, it was truly a gold rush in the world of VC. But then something happened. Like the room got very, very quiet. There was like no more energy left in the party. In order for us to get to the bottom of this, we have to understand first how venture capital works. VC by nature invest in early stage companies. What is an early stage company? A founder with an idea or a playbook or literally a napkin that draws out what he or she wants to build. A venture capital will fund it to bring that idea to life and help it scale. That is the complete opposite of what I do. Me, Kenny Finance, I'm a private equity baby. I spent 10 plus years working at the best private equity firms in the entire world, Blackstone and KKR. We buy old, mature, boring cash flowing businesses. That's on one end of the spectrum. The other end of that spectrum is investing in very early, not really proven ideas yet. But some of them work out. Like you can see what happens when a venture capital invests in a business like Airbnb or Uber in its early rounds. You can get massive 1,000 times plus returns on those VC dollars. But what also happens is a lot of them actually fail. So that's what a venture capitalist does. Find incredible founders that have an amazing idea that only need capital to take that idea to the moon. And that's what they do, they fund it. Now, big question, where do they get the money to invest in these founders and their ideas? They raise capital from other people. This could be high net worth individuals, it could be family offices, it could be endowment funds. They raise funds from other folks, take those funds to invest in founders and ideas. And that brings us to this illustration I want you to take a look at here. This is the LP-GP relationship. LP stands for limited partner. Those are people with money. The GP, that is the general partner, the investor that invests that money. Now, what does the LP want? The LP wants returns, aka their money back plus more. So what is the general partner's role, the VC's role? Their job is to find businesses, invest in those businesses, watch those businesses grow, and then eventually sell those companies or take them public, which is a liquidity event, so that they can get their money back and distribute it back to their investors, the LPs. Plain and simple. Step 1, raise a fund. Step 2, buy companies. Step 3, grow those companies. Step 4, exit at an IPO. Step 5, give the money back from the IPO to your LPs plus more. Very, very, very simple framework. That's how all of private capital works. But on the IPO and distribution step, something recently has gone very wrong. This is what leads us to what the heck is happening in venture capital today. So as I mentioned, from 2010 to 2021, you have seen a massive influx of capital from LPs going into venture capital firms. You are seeing big firms get even bigger. You are seeing new pop-ups of smaller firms raising funds and getting bigger and bigger as well. Now, what is happening here? The amount of capital in dollars for VC is massive. But what hasn't changed that much is the availability of really good businesses. And one thing about a GP, they have to put those dollars to work. They can't just sit there with the cash in their bank account and let it sit for 10, 20 years. They have to deploy it into ideas and invest it. And this is where I think a lot of VC firms went wrong. They were putting dollars into businesses that had great products, great growth potential, but they were not operationally and cash flow-wise solid businesses. They were burning money every single year. They had negative unit economics, and everything about their business model wasn't truly mature. And what happens when you have a fixed amount of venture capital and growth equity dollars and a very finite amount of really good quality businesses? You start to see valuations of companies start to go well beyond what they are truly worth. Like, I am talking about investors paying ridiculous multiples for companies that were burning cash every single day. And as Warren Buffett says, what eventually goes up must come down. So that's what happened. Tech literally crashed. And when tech crashed, VC crashed as well. Like, take a look at this chart here. This chart shows that the capital commitments to venture capital, meaning the amount of dollars that LP said, I want to put into venture capital firms, fell significantly. Like, we are talking about LP commitments falling 60% in 2023 and 2024, as opposed to the 2 prior years. That's insane. That's very scary as an investor. The next thing that happened, IPO markets closed up. What does that mean? That means that businesses that are private that wants to go public decided not to go public, because if they did, it will be very, very, very bad. I want you to understand the playing field of Wall Street. On the private side for businesses, like investing in private companies, there's venture capital and private equity. Now, when they go public, you then kick the ball over to the public side. And who's on the public side? The big bad wolves of hedge funds. And one thing about hedge funds, they don't f*** around. If a business is bad, if it is not profitable or has a path to become profitable, and if there is something that smells like an inefficient business model, it will punish the stock significantly. And that's why the IPO markets crashed. Founders of businesses that raise a bunch of capital at crazy valuations realized if they were to go public, their businesses were not ready for the intellectual rigor as well as the operational benchmarks of public equity investors like hedge funds. Like, they are the smartest people in the entire world for a reason. And when a business doesn't go public, that means that there are no distributions and returns for venture capital firms. Look at this chart on the IPO markets. It shows that in 2021, there were around 323 major IPOs. In 2022, with valuations crashing and folks just like realizing that tech was significantly overvalued, you saw the IPO markets literally fall and collapse to only having 20 plus IPOs the following year. And it is still barely recovered. Now, when the IPO markets crash, that means that no dollars are being returned and distributed to the limited partners of venture capital firms. Like, in this same period, you are seeing venture capital distributions fall to a 14-year record low. And the derivative of that is if you have less distributions going to LPs, LPs are going to say, you know what, you're not really giving me my money back. I'm not giving you any more money. And as an LP, they decide to allocate less to new funds. And if they need to have some piece of the VC pie, they will only give to the existing big proven ones that are actually delivering distributions. Are you starting to see the picture that I'm painting here of what is happening in the world of tech investing and venture capital? It's dark, it's slow, it's quiet. And I haven't even gotten to the scariest part. Like, the scariest part is the number of venture capital firms that are shutting down. Here's another chart from PitchBook that shows the overall count of active VC investors has fallen from 24,000 back in 2021 to a mere 13,000. That is a 55% decline over a span of 3 years. And this is very recent data. I'm talking 2024. And guess what? In 2025, things have done nothing but arguably gotten worse. Trump in office having trade wars with China and other trade partners, spooking the markets, having IPO markets still closed, having valuations and stock markets go up and down all the time, extremely volatile. If you are still a founder that raised VC and growth capital, you are still kind of worried to go public. Like, the story is still being written today of a very, very, very quiet VC ecosystem. Now, how do I know all these things? Not only do I read the Wall Street Journal every day, but I obsess over businesses and stocks and companies and investing broadly. And I take all of my insights of what's happening in the world of business, the economy, finance, investing, and I put those into a very polished, easy to read newsletter called Tomorrow's Fortune. And every single Friday, it's completely free. I give you guys exactly what's in the head of a private equity pro when it comes around thinking about investing. It's super easy. Sign up. The link's down in the description. You don't want to miss it. It's actually banger. And I put a lot of work into writing those things, so hopefully at least someone reads it. But let's move on to the segment where we see is there any optimism in the future of venture capital? And here's where I outline my thesis of what's to expect for the next 12 to 24 months for venture capital investors. My headline thesis is the quality of venture-backed businesses as well as the IPO markets will improve and open back, and you will start to see valuations improve and get better. But the thing is, I think LPs will start to understand that they will concentrate their venture capital allocation to the big, well, and proven investors like Sequoia and Andreessen. All the other ones, unfortunately, the smaller set of emerging managers and other funds that aren't as proven will have a very hard time fundraising subsequent funds. And the big question that I'm wrestling with today is the necessity of venture capital. Like, look at this headline that shows that this solo founder bootstrapped an entire business, one person, and sold it to Wix for $80 million. No VC raise, no outside capital raise. That $80 million, that goes to him. That just shows how possible it is for people to build multi-million-dollar enterprises without the need for VC dollars. Now, let me show you what would happen if he were to raise VC. Like, say he had the idea early on and he wanted to raise a $2 million round at a $4 million valuation, meaning that VC investor were to have 50% ownership of his business. Granted, they provided support, guidance, marketing, hiring, tech, all of that. But when it came to the exit, that VC gets 50% of the proceeds. So you are seeing a very questionable value proposition of, if you can build it yourself, if you can bootstrap, why not go that route? And right now today, with AI and tech and the tools and the availability of resources to build great businesses, do you really need VC? So now I toss the question to you. If you were to have an amazing idea, would you bootstrap it or would you raise capital from VC? Like, put in the comments down below, bootstrap or VC. I'm very curious to hear, like, do you think it is necessary and do you all think you need to have VC dollars to have a successful exit when it comes to your company? So that's the state of venture capital. It's bleak, it's scary, it will improve, but it might only improve for the top venture capital firms. And that's why it is so important to be mindful of what is happening in the economy, what is happening in the stock market, and what is happening to the overall quality of businesses, because that drastically influences the world of capital allocation. It's super important. All these things are connected. And if you guys enjoyed this deep dive of what is happening behind the scenes in the world of venture capital, do me a really big favor and smash that like button. It means the world to me as well as the rest of the community. And I think one other deep dive that you will really, really like, and it kind of hits home, no pun intended, is what's happening in the world of home affordability. So check out this next video where I dive deep into what is happening in the housing crisis and why is it that everyday Americans can no longer afford to buy a home. So check out that next video and I'll catch you guys there making smart money moves. Peace.